Cryptocurrencies, of all things, actually help lower interest rates in the United States. That might sound wild at first, but smart money is betting on it. And the key player, stablecoins. Stablecoins are a type of cryptocurrency designed to maintain a stable value, usually pegged to a currency like the US dollar. Unlike Bitcoin or Ethereum, they're not meant to fluctuate in price. They're meant to be useful to store value, transfer funds, and act like digital cash. And there's currently something like 260 billion of them in circulation as of July 2025. Now, why are they so appealing? Well, one, they offer a way to operate outside the formal banking system. For hedge funds moving assets cross-border, savers in high-inflation countries, or just those who want a more flexible way to hold dollars digitally, stablecoins are becoming an increasingly attractive option. There are two big macro trends driving this demand. First, investors are moving deeper into the crypto ecosystem. As more capital flows into the space, there's growing demand for a stable medium of exchange, something to park your value in when you're not trading tokens. Secondly, much of the trepidation about investing in cryptocurrencies is the lack of a tie to something in the real world. Stablecoins bridge the gap between fiat currencies and digital assets. Those pegged to the dollar are now emerging as a powerful new vehicle for holding and moving money, especially in emerging markets and decentralized finance. Now, here's where it gets really interesting: how stablecoins actually hold their value. Stablecoin issuers typically back each coin with short-term, high-quality assets like US Treasuries. So when demand for stablecoins rises, those issuers are going to need to go out and buy more T-bills to back the growing supply. This creates a new source of demand in the Treasury market. And when there's a big new buyer of T-bills, prices go up and yields or interest rates come down. In other words, if we see a surge in stablecoin usage, we could see a persistent bid for short-term treasuries. That demand could help push short-term interest rates lower, even as the Fed doesn't cut rates, and even as other market forces, like increased issuance, push in the opposite direction. It's a wild feedback loop, and one that might pick up steam given the fact that the Secretary of the US Treasury, Scott Bessent himself, estimated that stablecoins could easily reach a $2 trillion market cap in the coming few years. So in essence, the rise of crypto, which is often seen as a threat to traditional finance, might actually help the US government finance its debt more cheaply. So whether you're bullish on crypto or not, stablecoins are quietly reshaping global capital markets and might be having more of an impact on the TradFi world of treasury yields than ever.